Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's late November 2024, and things have moved on quite a bit since my last video prepared at the end of October. There have been two events of world-shattering importance. The first is that Donald Trump has been re-elected as President of the United States of America. And the second is that on the 18th of November, I gave a lecture on the 10th anniversary of the Institute at the Royal Automobile Club in London on the subject of money and inflation in the 21st century, particularly in the 2020s. Now, my agenda in that lecture was to explain why the inflation flare-up of the 2020s happened. Of course, it's not a new topic for me. In early 2020, I warned that the then explosion in the growth of quantity money was likely to lead to a sharp increase in inflation in the USA, the Eurozone, and elsewhere. And so, to me, this is rather familiar territory. And indeed, please look at the lecture. It really is the video for this month. But what I want to do today is to highlight one particular aspect of all this. I mean, plainly, Donald Trump's re-election is a setback for traditional economic policymakers who believed in free trade and balanced budgets and things like that, because we seem to be set for another 4 years of protectionism, large budget deficits, and so on. And so I think it's quite important to ask why this has happened. Why was Donald Trump re-elected? And without doubt, one reason was the inflation of the Biden presidency. The inflation of the Biden presidency was blamed on President Biden. Now look, what I did in spring and summer of 2020 when Donald Trump was president was to show that the policies then being pursued, when Donald Trump again, to repeat, was president, they were going to lead to inflation. And it was the decisions taken in that period, in spring or summer of 2020, by the Federal Reserve and to some extent the Treasury and the government, the American government altogether, that were responsible for the explosion in money growth that occurred and then, in my view, led to the inflation. Sure enough, Biden did then have needlessly large budget deficits through to a misguided fiscal expansion of 2021 and 2022. Having said all that, the budget deficit in fact fell under the Biden presidency, and I've argued, and I very strongly believe, that the dominant reason for the American inflation of the early 2020s was the explosion in money growth in 2020. It's very clear that very few American economists, if any, really accept this analysis. In my lecture, I did talk about that to some extent. I had quotations from Blanchard, Clarida, and others close to policymaking at that time. But what I want to do today is just to say something about a press conference in September 2020. Then to say something, I'm afraid, rather rude about the present chair of the Federal Reserve, Jay Powell. And then finally, I want to warn. We really shouldn't be surprised that Donald Trump has no respect for Jay Powell and therefore, larger picture, for the Federal Reserve and indeed all of the American traditional policy-making bodies in the USA. Because of the kind of thing that happened at this press conference. It's all too plausible that in the next 4 years we see an erosion of the Federal Reserve's independence in making monetary policy, with Donald Trump bullying Jay Powell and his successor around. And it's also very plausible that in the USA and in other countries too, there's a return to such things as prices and incomes policies to control inflation, not the use of monetary policy. Those will be my warnings. But now I'm going to, I didn't have time really on the 18th of November to run through these slides. They are some slides I wanted to refer to. The US money explosion really ran in a 5-month period to the end of July. In that 5-month period, broad money jumped by 19%, almost 20%. The annual rate of money growth in the year to June 2020 was 25%, the highest since 1943. The increase in companies' bank deposits in the year to mid-2020 in the USA was 40%. You're running a company, one of the most basic things you're looking at all the time is the bank statement and the level of the bank deposit. For all American companies taken as a group, their bank deposits jumped in a year by 40%. Now suppose you're a clever corporate lawyer who understands, analyzes, looks at company balance sheets all the time. If you're a clever corporate lawyer in private equity, in investment decisions, the way you assess the health of companies is looking at their balance sheets, looking at the businesses, of course, but looking at the balance sheets, looking at the bank deposits. Jay Powell, his background was as a corporate lawyer in private equity. He's a very smart guy. He appeared not to know in September 2020 that the bank deposits of US companies had risen by 40% in the year to mid-2020, which is the latest data, if you'd ever bothered to check it. If he'd known that, he surely would have been aware that there were very serious inflation risks coming up in the next year to 2 years. Anyway, he didn't know that plainly, otherwise he couldn't have said the things he said at this conference, at this press conference on the 16th of September 2020 after a meeting of the Federal Open Market Committee. He was asked at this meeting of the FOMC, he was asked, because there'd been quite a long period before this of low inflation. The Fed was being criticized because inflation had been 1.5%, not 2%. The forecast produced by FOMC members, I think there are 15 or 20 of them, were for inflation to be under 2% in 2021 and 2022. I'm not making this up. Nobody on the FOMC had an inflation forecast at that time, September 2020, of over 2%. So Powell was asked, this is a question being asked by somebody at the press conference, if the committee of the FOMC was confident that it could reach its new goal of aiming for inflation of about 2%. Why would one of those years, future years from the FOMC forecast, why should one of them at least show inflation being above 2% on the kind of forecast, compromise forecast produced on behalf of the FOMC members? The questioner, Powell, all the members of the FOMC did not expect inflation to exceed 2% in the USA between then and the end of 2022. That is the situation at that press conference in September 2020, as I said, when you'd had the highest growth rate of money since the Second World War, plus the bank deposits of American companies rising by 40%. And so what then is Jay Powell's answer to this? Because we think looking at everything we know about inflation dynamics in the United States and around the world over recent decades. Let me repeat that. Because we think looking at everything we know about inflation dynamics in the United States and around the world over recent decades, claim to a substantial amount of knowledge, if you don't mind, we expect it will take some time to get inflation back up again, get inflation above 2%. We expect that the economy will recover quickly now, but that the pace will slow as people go back to work, and that we'll still have an area of the economy, a big area of the economy, that struggles there'll be slack in the economy. The economy will be moving below maximum employment, below full demand, and that will tend to wear down, to put downward pressure on inflation. This is presumably out into 2021 and 2022 when, of course, inflation soared. You could hardly get, in my opinion, a more comprehensive piece of evidence showing total ignorance about the future of the American economy at that point. In the end, of course, inflation did take off, and as I said, it was blamed on Biden, and then Biden lost the election, above all, principally because of the failure on the economy and inflation. So now we have Donald Trump as president. This is what he said about Jay Powell. He's asked a question about him. He said this is a chap who turns up at the office every now and again, flips a coin and says, and people treat him like God. Plainly, Donald Trump won't be doing that. So let me just finish by saying that, in my view, this failure on inflation forecasting has wider significance. The economics profession really does need to get itself in order. It does really need to understand that inflation is caused by excessive growth of the quantity of money, as Milton Friedman always explained, as I've explained in a rather now too long career. And this is if you have the kind of money growth rates we saw in 2020, you will get inflation. It's not because of supply shocks and things. The supply shocks are symptoms. The Fed's independence is at stake, but over and above that, we may see a return to the kind of thing that happened in the 60s and 70s of governments interfering with prices and incomes directly to keep inflation under control. Where does the blame for that lie? In my view, it lies very solidly and very clearly with economists who've forgotten about the quantity of money, and that is the wider significance of this debate. Thank you.